I'm Timothy, and this is Retirement Guide USA. I create content like this each week to assist you in safeguarding your finances and comprehending the regulations that no one provides you with instructions for. If this seems beneficial, please subscribe. There is much additional information ahead. Here is the figure. Pursuant to the Bank Secrecy Act of 1970, all financial organizations across the United States, all banks, all credit unions, all savings and loans must by federal statute submit a currency transaction report to the Financial Crimes Enforcement Network, referred to as FinCEN. Whenever a client performs a cash operation surpassing $10,000 during one business day, that documentation is submitted on FinCEN Form 104. It contains your complete legal name, your social security number, your date of birth, your residential address, the precise quantity, and the time it occurred down to the minute. The bank possesses 15 calendar days to submit it. You will never receive a copy, and the bank is legally forbidden from informing you that it occurred. That is the regulation under 31 United States Code, Section 5313. I want to be exact regarding what precisely activates this, because individuals become confused on this point. This regulation concerns cash actual physical currency, and in some situations, cash equivalent instruments like money orders and cashier checks. It is not activated by a standard check you deposit a typical wire transfer, or your Social Security direct deposit arriving in your account. Those regular electronic transfers are not what this regulation is aiming at. And one additional detail that surprises people: the bank combines your cash dealings throughout the whole day. Depositing $5,000 at one location and $6,000 at another location, that same afternoon still totals $11,000 in the bank view. You cannot evade the limit by dividing locations. Now here's what individuals misunderstand in both ways. If you are a lower income retiree, your deposits may seldom approach $10,000, and that seems like security. It is not. I will demonstrate why shortly. If you are a retiree with substantial savings, you may be transferring funds between accounts receiving pension payments or consolidating accounts after a spouse passes. And each of those moments represents a potential flag. Both groups can proceed fully protected. I am going to explain exactly how. For each one, a currency transaction report by itself is not an accusation. It is mandatory paperwork. Millions get filed every year, and the vast majority trigger absolutely nothing. The issue is not the report. The issue is what happens afterward. And that leads directly into the second regulation almost nobody discusses, because $10,000 is not even the figure you actually need to be concerned about most. The actual figure sits below it. There exists a second type of report banks submit, and this one has no dollar limit at all. It is called a Suspicious Activity Report, an SAR, and a bank can file one on a transaction of any size: $2,000, $500. There is no floor. The decision arises from the bank internal compliance software examining your transaction history for patterns, not crimes patterns. And the pattern that triggers a SAR fastest is a series of deposits that added together would have crossed $10,000. Anything that looks designed to avoid the reporting requirement. Consider a woman named Diane. She is 67, a retired registered nurse outside Nashville. She sold her vehicle for $11,000 in cash because the buyer lacked a cashier check that day. Diane had learned somewhere that $10,000 was some type of government boundary. So she deposited $5,000 on a Tuesday and $6,000 on a Friday. Two separate visits, her own funds, a completely legal sale. The bank software saw two large deposits in 1 week from an account that had never held more than $3,000. And it filed an SAR with FinCEN. Diane did nothing wrong, but that report now sits in a federal database, cross-referenced against everything she does going forward. Here is the part that impacts people the most. The bank cannot tell you an SAR was filed. A bank employee who alerts you commits a federal offense called tipping off, punishable by up to 5 years in prison. So the silence is not an oversight, it is the law. And that leads directly into the most critical aspect of all this, because once people learn about the $10,000 rule, they all have the same impulse. That impulse is a criminal offense. Pause for a second and examine your actual checking balance, not last month's statement today number. Hold that in mind because everything from here applies directly to it. When people learn about the $10,000 reporting rule, the first thought is almost always identical. Keep deposits under it. Divide it somewhat today, a little next week. That impulse is not a solution. It is a federal criminal offense called structuring. Under Title 31, U.S. Code Section 5324, it is an offense to break up or assist breaking up any transaction with the purpose of evading the currency transaction report requirement. You do not have to be laundering money. You do not have to be committing fraud. If every dollar you possess is completely legal, earned, inherited, gifted, and you intentionally deposit it in smaller pieces to remain under 10,000, you have committed a federal violation. The penalties are serious. Under $100,000 in a 12-month span, up to 5 years in federal prison, and up to $250,000 in fines. Over 100,000 are tied to other illegal activity up to 10 years. And in both cases, the government can seize the money through civil asset forfeiture before any conviction happens at all. The burden then falls on you to prove the money was legitimate. And while you are proving it, the money is already gone. This is not theoretical. A federal oversight body, the Treasury Inspector General for Tax Administration, reviewed a sample of these structuring seizures and found that in the cases where structuring was the stated reason for the seizure, the vast majority, over 9 out of 10, involved money that had been earned completely legally. The legislation was written to catch drug traffickers and money launderers. In practice, it was primarily affecting ordinary, honest account holders. That public reaction forced meaningful reform. In 2015, the IRS announced it would stop seizing lawfully sourced funds in most cases. And in 2019, Congress restricted the IRS specifically from seizing accounts on structuring suspicion alone when the money came from a legal source. But those reforms apply to the IRS. The Department of Justice can still pursue these cases, and structuring itself is still very much a crime on the books. The lesson has not changed. Never break up a transaction to avoid that limit. Here's who gets involved in this most often. Retirees who receive irregular large lump sums rather than steady paychecks. A final pension payment, a life insurance settlement proceeds from selling a home or a car, an inheritance, a retroactive Social Security payment that lands all at once. These are not wealthy people doing anything unusual. They are careful people whose income arrives in large, infrequent amounts that look unusual to software built to catch criminals. And you will never be told any of this happened in real time. It is also worth understanding why retirees specifically get flagged more than working-age account holders. When you were employed, your money mostly moved in one predictable pattern. One paycheck direct deposited, same amount, same schedule. Retirement income does not work that way. You might have Social Security landing on one date, a pension on another, investment dividends on a third, and then layered on top of all that occasional large one-time events, a required withdrawal, a home sale, a settlement. Automated monitoring systems are built to notice variation, and a retiree financial life is naturally more varied than a single steady paycheck. On top of that, many retirees no longer have an accountant or advisor assisting them the way they might have during their working years. So these situations build up quietly, unmanaged, until one of them causes a real problem. None of this means anything is wrong with how you are handling your finances. It just means the system was built around a different, more uniform pattern than the one retirement income actually follows. There is also a broader context worth knowing. The Bank Secrecy Act was passed in 1970 to combat money laundering and organized crime, and it was expanded considerably after 2001 under the USA Patriot Act to include terrorism financing. The system was built to catch criminals. It was never built to target retirees, but the software scanning your account does not know the difference between a grandmother moving her own savings and someone moving illegal funds. Both patterns can look identical to an algorithm. Documentation is what tells them apart. And to be clear about what a CTR filing actually means for you, FinCEN collects the reports and the IRS may access them during an audit if some other separate reason for suspicion already exists. A CTR by itself is not an audit trigger. It is a data point sitting in a database that only matters if something else brings investigators to it in the first place. So here's what I want you to do. The exemptions, the deductions, the refunds most seniors already qualify for, but never claim. I have placed them all in one place state by state, form by form, so you do not waste hours searching through government sites. Everything is laid out quickly and simply so any senior can find exactly what applies to them. No matter what state you are in, there is money you are leaving on the table. It is called the Senior Exemption Playbook. It is in the first pinned comment right below this video. Just tap it once and you will have everything you need. Now stay right here because the next part is the single most valuable protection most seniors never use. And it is the reason I created this entire video. The protection is not avoidance. It is documentation and transparency. That is the only thing separating a routine CTR filing that goes nowhere from a real problem. Consider a woman named Sylvia. She is 71, a retired elementary school principal from Baton Rouge. Her brother passed away and left her $38,000 from his estate. She walked into her bank, deposited the full amount in one transaction, handed the teller a copy of the estate settlement letter, and the will naming her as beneficiary, and asked the teller to note the source. A CTR was filed. Sylvia never heard another word about it. The documentation made sure of that. That is the principle. Deposit the full amount in one transaction. Bring paperwork that explains the source, a bill of sale for a vehicle, a gift letter from your child stating the amount, the date, and that it is a gift with no repayment. Expected an estate settlement letter, a pension award letter, a Social Security notice of payment. Keep a copy. You will likely never need it, but if the question ever comes up, you hand over the answer instead of scrambling for one. There is more to safeguarding yourself here than the deposit itself. And this is where I want to add a few things that do not get talked about enough. One beneficial habit is keeping your money in separate categories instead of running your whole financial life through one checking account. Your checking account should really only hold 1 to 2 months of living expenses, plus a small cushion. It is your daily tool, not your storage. A separate high-yield savings or money market account, FDIC insured, is a better place for your 3 to 6 month emergency reserve, and it actually earns you something instead of sitting at a fraction of a percent, while inflation quietly reduces it. Money you will not touch for a year or more can perform better still in something like short-term Treasury bills or CDs. Beyond keeping your accounts cleaner and less likely to trigger flags, this structure solves a second, quieter problem. Inactive cash in checking is losing real value every year. It just sits there. If you are 73 or older and required to take a minimum distribution from a traditional IRA or 401k, a lot of people take the whole thing as one lump sum in December and drop it straight into checking, which is exactly the kind of single large deposit that stands out, if your plan allows it. Taking that distribution in smaller scheduled amounts across the year is not structuring. Structuring means breaking up a transaction specifically to avoid a report. A scheduled ordinary distribution setup for planning reasons is completely legitimate. The difference is intent, and a routine recurring withdrawal reads nothing like someone trying to conceal something. Family gifts matter here too. There is an annual gift tax exclusion, $19,000 per person per year for 2026 that you can give or receive without triggering a gift tax filing. Go over that amount and you are generally supposed to file Form 709, not necessarily to pay tax, just to report it. Large unrecorded transfers between family members are exactly the kind of thing that becomes a difficulty if your account ever gets a second look. So, keeping a simple written record protects you either way. Two more things worth knowing. First, a single high-income year, a big retirement account, withdrawal, a Roth conversion, and inheritance selling a rental property can push up to 85% of your Social Security benefit into taxable territory. And separately, it can trigger IRMAA, the income-related adjustment that raises your Medicare Part B and D premiums 2 years later based on that year income. People take one big distribution, forget about it, and get surprised by a higher Medicare bill years afterward. Spreading large income events across tax years when you have the option quietly protects you on both fronts. Second, if you are now using apps like Venmo, PayPal, Zelle, or Cash App for selling things or receiving money from family, know that activity can generate its own tax paperwork. And if those apps feed directly into your main checking account, it all blends into the same picture the monitoring systems are watching. That does not mean stop using them. It means keep that activity as organized as everything else. Here is your action plan. Step 1. Before you deposit any large sum, gather the document that proves where it came from. The bill of sale, the estate letter, the gift letter, the pension notice. Step 2. Deposit the full amount in a single transaction. Never split it across days or branches. Step 3. Hand the source documentation to the teller in person and ask them to note it on the transaction. You are allowed to do this, and it protects you. Step 4. Keep a personal file, physical or scanned, of every supporting document for any transaction over $5,000. Step 5. If you are moving your own money between accounts or closing one after a loss, do it as a single wire with a memo line explaining why, and keep both statements showing the same day transfer. Step 6. Never under any circumstance break a deposit or withdrawal into smaller pieces to stay under $10,000. A large legitimate transaction is fine. Trying to avoid the report is the only thing that is actually risky. One more thing before you go, because I think it is the most reassuring part of everything I have covered today. None of this means you should keep cash at home to avoid the banking system altogether. I understand the appeal. No bank, no reports, no algorithm watching. But that is a bad trade. Cash sitting in a house is not insured. If there is a fire or a theft, it is simply gone with no way to recover it. Large amounts of cash can create their own legal complications if you are ever asked to prove where they came from. And, like idle checking balances, cash at home loses real value to inflation every year while earning you nothing. The answer was never to hide your money. It is to organize it. Clean structure beats concealment every single time. Your bank is not required to explain any of this to you, and it is not allowed to warn you after the fact either.